Okay. So on notes receivable, supported by a formal note, piece of paper. Written promise to pay a certain amount of money, specific date. It's a negotiable instrument. What does that mean? I can sell it to somebody else. Okay? Negotiable instrument. That's it. The maker signs in favor of the payee, so they sign that they're going to pay, right? Interest bearing has a stated interest rate, or it's zero interest bearing, interest including the face amount, or it might be a nominal interest rate. Okay? There is no such thing as not paying the effective interest rate. We always pay the effective interest rate. So if somebody gives you a zero interest note, what happens? If it's a note receivable or a note payable, either side of the deal, right? If there's no interest on it, what really happens? They charge you. You almost can't buy furniture and pay interest on it, huh? It's always interest free. What have they done? They've raised the price. You pay more. You walk in with cash, the price suddenly gets an awful lot less, right? Because they don't have the time value of the money there. They're happy to give you a discount for that, right? Okay? So what we'll do is we'll do something called compute the interest, okay? Which means calculate how much the interest is. That's it, okay? There's also, though, nominal interest rates, an interest rate below the market rate. So let's say you guys own two companies together, right? You're the shareholders of the two companies. And those two companies do business with each other. One company loans money to the other company. Come on, they're related parties. You can make the interest rate be whatever you want. You can make it zero. You can make it lower than market rate. You can make it higher than market rate. You can transfer wealth between the two companies with the interest gain. Right? One benefits, one loses. Anytime you're doing business in a company, it's related party, right? So any related party stuff, we look very critically at the notes. So let's do one. Let's say that we have this kind of a situation. Okay? Let's say that we have on one side, what are you doing? Huh, that's weird. Okay, anyway. Why is it bringing the little bit apart? Guess we'll use that size. All right, anyway. Let's say I have a note receivable. Note receivable, which on the other side would be a payable. So when we do payables, it's just a mirror image, right? Still keep the interest. It's $100,000. We charge 3% interest, but the market rate should be 10%. Okay? What do we want to do? And we record the note. Okay? And let's say it's I'm accepting the notes receivable and I'm selling them product. Okay? Intercompany, maybe. Or it could be I'm selling to somebody and I'm just going to charge them more for it. Notes receivable, sales. How much is the note receivable really? And how much is the sale? Let's make it a one-year note so our math is easy. You do it for the period of the note, of course. Let's make it 1 year exactly. 10%. So you don't have to compound. What would you do? How much is the note receivable? How much is the sale? You can do it two ways. You can either make the note receivable be the net, or you can make the note receivable be the full amount of the 100 and then have a discount. It can be a discount on this note receivable. Okay. Sale is less than the face amount of the note. And then we'll figure out how much interest is going to be earned on this note. Is the interest really 3%? No. What's the interest really? What's it got to be? Always, what does it have to be? The market rate. It's got to be the market rate. Okay? So if it was zero, you just wouldn't have 3%, it'd just be zero. Does that make sense? So zero interest bearing, they show you in the book, is just a simpler version of the same thing here. It'd just be zero. Okay? Figure out what the cash flows are and just kind of back to that. It's only 1 year, so it's going to be really simple. do you do? What are the cash flows? What's going to be paid off in this note? 1 year from now, how much is going to be paid off? Future value 1 period from now, what's going to be paid off? Face value of the note of 100,000. Would you say? Yeah, 100,000 is going to get paid off. That's cash flow. 1 year from now. Everybody agree? What else is it going to pay? 3%. 3% of 100,000. What are they going to pay? 3,000. Now, obviously, if there were interest payments over time, you'd have to take the discounted present value and annuity then, wouldn't you? Everybody got it? So you'd have the annuity plus the lump sum and add the two together. We do this all the time. There are present values everywhere. Okay? So I've got $103,000 that I'm going to receive when? 1 year from now, and the amount I really should be charging is how much? 10%. What do you want to do with that 103,000? How about discount it for 1 period at 10%? Slide 1.10 into it, huh? Right? It's only 1 period. Everybody agree with that? Just 1 year. Whatever period it is, so you'd have an annuity and a lump sum both. Okay? What is 103 divided by 1.1?
93636.36.
93636. 93,636. So we just round it close enough. Okay? So what's the sale? To discount the present value of the note. What would you have done if there was no interest? There wouldn't be the 3,000 interest coming in, so this would be 100,000. You'd discount it, you get a different number, of course. Got the idea? Everybody see it? You can either record the note receivable at 93,636, or you can record it at 100,000. Either way, you have a discount on the notes receivable. See it? You can either put the discount in the note itself, or you can have an account discount on notes receivable, which is what kind of an account, everybody? Note receivable is an asset, credit balance, an asset account, it's a contra asset, right? Got it? How much is that? 6,364. See, once you know how to do this kind of stuff, you kind of got it made. Bonds will work exactly the same way, don't they? Same stuff. Okay, so let's say that was January 1st, and then we finished the deal up December 31st. What would we do at December 31st with this thing? Oh, by the way, their purchase is 93,636 also, and they have a note payable with a discount on the notes payable, right? Although they might have a different number because they might have a different market rate. That makes sense on the other side of the deal? Your customer might do it differently. Be a different amount because they have a different interest rate than you would, maybe. Okay? Different discount rate. Could happen. Because we're not going to tell them what our discount rate is. They're not going to tell us what theirs is. Got it? It'd be their cost of capital and our cost of capital, probably. We'd have to estimate rates. Okay? All right, then what? They're going to pay us. How much do they pay us?
103.
Yeah. And you debit cash 103. If it was zero interest bearing, it'd be 100. It's too easy. Credit what?
Note receivable for 100,000.
And what are you tempted to do? Credit interest revenue for 3, huh?
Discount.
You got to get rid of the discount. How much? And if it's for a number of periods and there were payments, you'd be amortizing it over time, right? Okay, you could do that too. Okay. What else we got? Looks like how much? $9,364. What's that?
Your interest revenue.
Yep. It's the interest there. It's the interest revenue. Ta-da! We're brilliant people. Okay? Everybody see it? It's easy, isn't it? Nothing to it. You do that. All right. So that's the zero interest bearing. There's no such thing. I'm sure you know that, of course. Okay? Originate from customers who need to extend payment period. Okay, so I got an account receivable from the customer and say I can't pay you on time. What will you immediately do? Please sign a note. What goes away? When we go to court and they haven't paid us, then they say you never delivered the product. No, that's the best thing. It's enforceable now, right? They agreed that they owed you the money. They might not be able to pay you. You're going to charge them interest, but you think you're going to get paid the interest? They couldn't pay the receivable, you guys. Are they going to give you the interest? Maybe not. You might not get it. So will I record interest revenue during the term of the note? No. I'll wait till they pay me, right? If I'm sure they're going to pay me, right? Pretty sure it's probable. What's an asset? Probable future economic benefit. I won't recognize the revenue and recognize the interest receivable unless it's probable they're going to pay me. That makes sense? But I'll still charge them the interest, right? Hoping I'm going to get it at the time. Yeah, everybody got it? So I'm trying to increase the odds of collectability by doing that. Now, what would the journal entry be, by the way? They owe me $100,000, and I take a note for the account receivable. Debit what? No receivable. Credit what? Account receivable. Big deal. Okay, so that's it. In this case, I just recorded the sale, didn't I? The example I just had up, right? I took the note at the time of the sale. So you can do that. Okay. High risk or new customers. I want a note from you. I want you to sign you owe it to me. If I send things to you, right, and I don't get paid in advance, I'm just going to trust you on open account receivable. What if I don't know you yet? Maybe not. Maybe I want you to sign a note. Or I want the cash in advance, right? Or I want a bank letter of credit, right, that they're going to guarantee payment or something. Okay. Loans to employees and subsidiaries. It's real common. Okay? Those are all related party entities. Make sure you impute interest on them. Always watch that. That's what we just did was impute interest, right, guys? That's imputing the interest. Okay? You don't see the interest in the deal, do you? Looks like the interest is $3,000 on the note we just did. It's really $9,600. Everybody got the idea of this? No big deal. Okay, sales of property, plant, and equipment, we might accept notes, right? And then lending transactions, which is the majority of notes. We can lend people money, you know, and those would probably be at market interest rates. Okay, so then recognition, recorded face value less the allowance. We just did that. Recorded present value of cash expected to be collected. Yeah, okay. Oh, I guess we should talk about the allowance. Could you have an allowance for doubtful accounts on notes receivable just like you do accounts receivable? Of course, right? Of course. So and you account for it exactly the same way. And we might have a premium or a discount on recording it. We did that. So calculate the present values of it. Just did for one period, and they're going to do the same entries. Okay. Show you a zero interest bearing note. You can crank through that. I wish they'd show you one where there was nominal interest, but I don't think they did they? For the receipt of the note, face value, present value of the principal, present value. Yeah, they did. They did present value of principal, present value of interest. They've got 3 payments here at 12%. So it's just like doing a bond, isn't it? We got the present value of the note, and then we've got the present value of the annuity payment. We add the two together, and guess what? You know what the sale was, or you know the amount that was really borrowed, right? And the rest is interest. Got the idea? So same thing. And there it is, just what we just did. Okay. Same thing. Just kind of. By the way, when you go to, let's go back to that a second. If I went to the bank and I borrowed, I'm going to pay him $10,000, and they gave me $9,520. Right? What did I really borrow? $9,520. Right? I'm going to pay him $10,000. What's the $480 going to be when I pay him back? Interest expense. Yeah, interest expense. Yeah, that's all it is. Okay, so no big deal, right? And if there's a difference between the market rate and the stated rate, right? It's either a nominal interest rate or it's zero, right? That difference is going to be part of the interest expense, right? That's all that's happening. It's not just not a big deal. Okay, and here they show the amortization. As they're receiving the cash, the interest revenue is really more because it's the discount, right? Because again, there's a difference between the stated rate on the note and what the market rate was. It works just like a bond does, okay? We did the principal discount. So crank through a few of those. Okay, here's the zero interest bearing notes. Okay, notes received, property, plant, and equipment. You could have no interest rate stated, or it's unreasonable, or the face of the amount of the note is materially different from the current cash price. What would we think then when we're doing certain goods and services? Example I just did with you is that, right? The sale price is really what? The discounted present value of all those future cash flows. What's everything worth? Asset, liability, equity, revenue, or expense. The discounted present value of the future cash flows. And you guys, I'm really pleased with you. You are really good at calculating those, aren't you? And we use them over and over and over and over. We're going to use them here in the notes receivable. Guess what? Notes payable, you do the same thing. Okay? Time value money, right? Okay? So. Boy, we're just flying through these. I want to get through these. Oh, we should mention. Too fast. Valuation notes receivable. Short term is usually recorded where? What value? Net realizable value is the same as accounts receivable. Why, if it's short term, less than a year, can we do net realizable value? Why don't we discount accounts receivable?
It's not material.
Yeah, we think the discount would not be material. Same thing with accounts payable, right? How about notes receivable current, notes receivable, notes payable, notes receivable current, and notes payable current? How about those? Same issue, right? It's not material. That's the assumption, right? Okay? All right. What if it's long term? FASB requires companies to disclose not only their cost, but also the fair value of the notes to the financial statement, the notes to financial statements. So I would show it's still a historical cost, but I would mention what the fair value is. So if the fair value goes down, I really got effective loss, right? But I don't record the loss. Fair value goes up, right? I have effectively a gain, but I don't record the gain. Everybody got it? So they're unrealized gains, unrealized losses, but we don't record them at all. Okay, everybody good? So it requires the cost and the fair value in the notes. On the payable side, we don't bother with that, which just seems kind of strange to have gains and losses on those too, but we don't do it. I think what we're worried about is conservatism. If the value goes down, we want shareholders to know, users of the financial statements to know. Okay, good. All right, this one's interesting. The fair value option. What page is that in the book? I'm going to make a note of this. Make sure you get it. It's a little bit.
Yeah.
365. Sure you get this. Fair value option. Unrealized gain or loss. Where does it go if you adopt the fair value option? Now it says here that you have an option to use fair value as a basis. If you choose the fair value option, what does that mean? I am going to keep my receivables at fair value. My notes receivable at fair value. These are the long-term ones, right? Receivables are recorded at fair value. Unrealized holding gains or losses are in net income. What does unrealized mean? I didn't sell the note, its value changed, there's no cash change, and realization is cash flow, right guys? Recognition is recording it. So I'm going to recognize it, recording it in the financial statements, make a journal entry. I'm going to recognize it in the financial statements as net income, therefore, what's happening? If it increased in value, I debit the asset, right? And credit unrealized gain on my income statement, it goes down in the non-operating section, right? Which increases my retained earnings, which of course is more equity.
Not unrealized, the comprehensive income.
No, this one is net income. Ah, this is different than that available for sale stuff, right? Okay. Unrealized on trading securities hits the income statement too, right? Because it's immediate, it's going to happen soon, and that's the idea with this too. We think it really happened, so we let it hit the income statement. Available for sale short-term and long-term, we think the value might readjust, right? We might get the gain, have the gain taken away from us, or get the loss back, they recover, right? So that we go to other comprehensive income with. So this is different. That's a great comment, okay? So yeah, it's part of the income, Everybody got the idea? So you're increasing the note, and you're increasing equity, increasing assets and increasing equity. The equity is increased because retained earnings went up, right? By the way, you'd be increasing the available sales securities, you'd be increasing equity too, but it goes through other comprehensive income. It wouldn't hit the income statement. This one hits the income statement, and therefore retain earnings. Yeah. Company reports the receivable at fair value each reporting date. Now, key point is, once you adopt it, you cannot change back. Once you adopt one or the other, I'm either going to use fair value, right, or historical cost. You can't switch. Point to point. Okay? Make sure you got that, and they show you how to do it. Right? You showed it unrealized holding gain or loss on page 365 towards the bottom of the page. Not a real big deal, but you need to know what it is, what's going on. Okay? And I kind of like the fair value option personally. What's a better measure to have in your financial statements, fair value or historical cost? Fair value. If you know what fair value is, if you can measure it. Why do we do that for land? We don't know what fair value is. Here, we can use the fair value because interest rates are changing, so that's what's changing the fair value. True? When on debt securities, and therefore in investment securities, right, that are interest-bearing, right, interest being paid, when does the value change? And interest rates go up or down. If interest rates go up, what happens to the value of a bond?
Goes down.
Goes down. Right? Interest rates go down, goes up, because the stated rate's not changing. Is that any different for a note receivable? Of course not. Same deal, right? The stated rate is fixed. Market rates are changing. Okay? So you need to get your head around that. Get comfortable with it. Okay, international financial reporting, they also have a fair value option. Companies may elect at the time of financial interest is originally recognized, or when some event triggers the new basis for accounting, they got to continue to use it until they no longer own the instrument. If not elected, the data registration company may never use fair value option on that specific instrument, but each instrument they get to decide. We do on everything all together. Okay. This is just an example of it. Just a single category. Okay, so disposition of accounts and notes receivable. So here we go. Owner may transfer accounts or notes receivable to another company for cash. You know, competition, sell receivables because money is tight. Billing and collection are time-consuming and costly. We just want it to go away. You know, but and we're granting credit in the first place because of competitive pressures, right? Transfer is accomplished by secured borrowing of some kind. It's either collateral for the debt or it's assigned for the debt. By the way, there are two types of assignment. There's assignment where, again, assigning the receivables to somebody means it's collateral for the debt, but when you collect the money, right, the cash from that particular customer, you must give them that cash. Got the idea? If it's just collateral, when you collect the money, you use it for whatever you want. And when the debt's due, you just pay the debt, right? That's just collateral for the debt. And you just put that in the notes to the financial statements. If it's an assignment, when I get paid that cash, I must give it to the person I borrowed the money from. Does that make sense? Or if they don't trust me, I might have my customers pay them directly. They keep their share, and if they collect more than their share of what I owe them, right, they'll pay me the remainder. Does that make sense? So they're more secure then. So there's two ways of doing the assignment too. Okay? You guys are really excited about this. It's good stuff. Okay? So, secured borrowing and sale to receivables. So, here we go. So, we get an example here. March 1st, they provide a sign. So, we're going straight to sign. Again, if it was just collateral, what would it be? Footnote disclosure that it's collateralized, right? So, all my receivables, maybe my inventory too, is collateral for my short-term borrowing, maybe, for my operating line of credit, right? Revolving line of credit. I borrow money and it goes up and down as my inventories go up or down and my receivables go up or down. I borrow more, repay, that kind of thing, right? Okay? It's just a continuous line. They renegotiate every year, basically. Okay? And you're probably paying prime interest rate plus a point or two, 1% or 2 or something like that, right? Okay? It's revolving line of credit. Lots and lots of times your receivables are tied up that way, your inventory is tied up. Do you want to have your receivables be collateral for debt if you don't have to? No. Why not?
You have more freedom.
More freedom, you can borrow more. If they're not collateral for debt, you can borrow from somebody and have them be collateral for the debt. Why might you have them be collateral for the debt? One, they won't loan you money without collateral, that could be. Or two, they might give you a better interest rate, right? Get collateral, that's all. Everybody got the idea? So that would just be disclosed in the notes, the financial statement, that it's tied out, it's collateralized, right? Okay? In assignment, we're going to actually have to make some journal entries for it, okay? So these provide, they assign 700,000 receivables to Citizen Bank collateral for 500,000 notes. What? 700,000 for 500,000? They're only giving me $500,000? They ain't give me that, maybe, right? 500,000, and I tie up 700,000 in receivables? Yes. Got it? Okay, so this is not real great deal with it. Okay, that's what we do. Okay, they continue to collect receivables. The account debtors are not notified of the arrangement. Okay, that's how they set it up. It could be the other way around, right? You could have the bank collect the receivables. They assess a finance charge of 1% of the receivables and interest on the note at 12%. Is this 12% interest? Of course not. It's 1% up front plus 12% as time goes by. It's more interest, isn't it? This is a more expensive way to borrow. If I just had the note as collateral, or I'm sorry, the account receivable as collateral for my borrowing, I'd only pay the 12%, right? I wouldn't have that other 1%. So this is getting more expensive. They make monthly payments to the bank for all the cash it collects. So here we go. What's going to happen? Wow. Take a look at this thing. It's the same example as the book. What page are you on?
367.
367. Look at that. Okay. So what's going on with this? I credit the note payable for the amount I borrowed, but they charged me what? 1%. Wait a minute. They only loaned me 500,000 face amount. And they charged me 7. 1% of what? The whole 700,000. This is really expensive, isn't it? Who you know, right? Okay. So they're only giving me 493. And they took the money up front, which is more interest. I only borrowed 493, right? And I'm going to pay them back 500, plus I'm going to pay the interest. Got the idea? Much higher interest rate, and we can calculate how much interest it is a percent, right? Just take the total amount you paid them, amount of time, right? How much you borrowed. Okay? And what the bank would do is to reverse. Debit notes receivable, credit interest revenue, credit cash. It's going to become revenue for them. It's expense for us. This is borrowing, so it's interest expense, not a loss, right, guys? It's a loss if I sold them when we get to factory. Okay? They collected 440 of the accounts, less cash discounts of 6, and the discounts are our problem, of course. Okay? We're how it mills. Plus a receipt of 14,000 of sales returns, example they give. So, okay, fine. I get 454 less receivables now, credited. Okay? Debit cash, debit sales discounts, debit sales returns and allowances. I'm going to eat those. And even if they were collecting the receivables, I'd still eat those. Right? They're my problem. Bad debts are my problem. Sales returns and allowances, sales discounts, they're going to be my problem. Okay, anyway, the bank does nothing, of course, because they got nothing. That makes sense? If they were collecting it, they would have debited cash, right? Okay, and it would have gone against the note receivable. So, okay, makes sense. All right, anyway, so now we're going to send them the money plus accrued interest. So I'm going to give them the cash I received of 434, and if the terms say plus interest, of course you'd add the interest. That makes sense? What's the interest going to be based on? Not the 700,000, the 500,000. But we only borrowed 493, you guys. Right? And we got 1% of the 700, right? That we're going to have to pay, and we're going to have to pay interest on the 500. So, the way it works. Okay? Much higher interest rates than it looks like. Okay, so anyway, debit interest expense, debit notes payable, right? For the amount of principal we paid them, and credit cash. They would debit cash, credit interest revenue, and credit notes receivable, and they've earned 7 plus 5 interest so far, huh? Okay, then in April, we collect the balance of the receivable. So they less than 2,000 written off as uncollectible, so that's another 246. So 454 plus 246 is the whole 700. Is that right? Everybody see it? Collected the whole thing. Okay? 2,000 bad debt write-off. How do you write off bad debts? Credit accounts receivable, debit allowance, right guys? Everybody knows how to do this. Okay? And what do we have? Cash at 244. And we are going to not give them the whole 244. Why? We owed them 500. We paid them 434. How much do we owe them? 66,000. Is that right? And so we're going to get rid of the debt of 66,000, plus we're going to pay them interest. But what are we going to pay them interest on? The 66,000 that we owed them at the beginning of the month, right? So it's 66,000 plus, or 66,000 times 1% for 1 month, right? Everybody good? So how much is that going to be? $660. So we add. Pretty simple, huh? Day debit cash, credit interest revenue, credit notes receivable. About what interest rate is this? Let's say we did it all in 1 month. Let's say we did it all in 1 month. What would it have been? If we paid the whole thing off at the end of the first month, what would the interest rate be for 1 month? Figure this thing out. What is it? If I gave him $7,000 plus $5,000, $12,000, right? Leave off the bottom line. It affects the sum, of course, with more interest, right? But what is $12,000 divided by the 493 that I borrowed? If I paid it all back in 1 month, right? What's 12,000 divided by 493? What interest rate did you get? 2.43%. But that was for how long? 1 month. Take it times 12. You want to assign stuff. Or would you rather just go borrow money at 12%? Okay. Huge, isn't it? They really get them. Okay. Now the risk, of course, for the bank is that the receivables don't come in very fast. Then they're just getting 1% a month for those months, right? Because that extra 1% up front is really nice if you get paid soon enough. But if it takes you a year to collect it, well, obviously then they don't want your receivables. So they're going to be that slow. You got the idea? Here's your risk. So that's the way it works. Everybody good? It's pretty simple, really? Did you do one of these? Maybe not yet, but yes. Okay, so let's do it again. This time they have $500,000 they assign for collateral of as collateral for a $300,000 loan. Calls for them to collect for Prince company to continue to collect them. They're going to assess a finance charge of 2%. Interest on the loan is 10. Okay, prepare the entries about that. Okay. So what do they got? A finance charge of 2% of the 500. Notice it's the 500 again, just another example. And the note payable is 300. Then they collect a bunch of the receivables. Okay, they collect all 350. Okay, so they're going to pay off the entire note payable plus the interest expense of 7,500 and pay out the cash. They paid 17,500 of interest on a $290,000 note for 1 month. Again, you can calculate it's real high, right? Okay, 2% up front. Wow, this one's huge. What's that interest rate? 2% plus 10%. Okay, so a little less than a 1. Is that close to 36%? 31. Okay. Okay. So let's do this one. Disposition of accounts and notes receivable where we're going to sell them. Okay, now I have even poorer credit. Okay? They don't want to loan me money. So sale with and without recourse. Without, the purchaser assumes risk of collection, right guys? It's an outright sale of the receivable. The receivable is no longer mine and the credit accounts receivable. They now belong to the factory, the finance company. Got it? So I factor with them. They take the receivable. I sell them to them. I no longer have them. Now I don't have interest expense because I can borrow money, right? I have no debt. I just don't have a receivable. Debit, cash, credit, receivable, right? What do I have instead? Loss. Okay? A loss. There's always going to be a loss. Okay? And they're not really going to have interest revenue because they didn't loan us money. What are they going to have? Factoring revenue. Okay? From buying receivables is how they think about it. Sell with recourse. What does that mean? If they don't collect, they can come back and get it from me. Okay? Sale without recourse. Without recourse, they can't come after me. With recourse, what's the deal? They can come after me, right? So the seller guarantees payment to the purchaser, assuming we can pay, and we use a financial components approach. So here's our first financial components approach. Yeah, they're finance companies or banks that buy receivables for a fee, okay? So the customer is going to pay directly to the factor, right? Instead of to me. The factor gives us money, right? Gets a credit review, and the customer's still buying from me. I'm still shipping the goods. but the factor now owns the receivables and they get paid by the customer. Everybody good? That's how the thing's gonna work, okay? And I get my share up front. This allows me to stay in business, right? I can pay my bills. I get money out of my receivables real fast. But what happens to most of my profit on my sales? It goes to the factor. Got it? You have to have quite a profit margin to be able to handle this on a long-term basis. So here's Crest Textiles in this industry. It's done a lot. They factor $500,000 of accounts receivable with commercial factors on a without recourse basis. They have a finance charge of 3% up front of the receivables, retaining amount equal to 5% of the receivables for probable adjustments. That's in case there's bad debts. So they're not at risk for that either, right? So even without recourse, they've got that left, okay, protected. Crest Textiles and Commercial Factors make the following journal entries. So here we go. It's going to be a receivable of $500,000, right? And we just do it on the $500,000, so it's not more receivables tied up. This is not collateral, right? This is actually selling. So they're going to take our whole $500,000 receivables. So we credit our receivables, they debit the receivables, right? Accounts or notes receivable, they don't want it, doesn't matter. And what they do is they charge us what? A fee of 3% for doing it for us, right? That's a loss for us. That's, instead of an expense, it's a loss, huh? Okay? So I'm never going to see that $15,000. For them, it's financing revenue, right? Or factoring revenue. Make sense? I don't like financing revenue very well. I like factoring revenue better. Financing implies what? You earned interest. But you are providing the financing. There's nothing about that. You gave cash wages to buy, right? Okay? So yeah, so that comes out. And then also, they hold back $25,000 in case they don't collect the whole $500. The first $25,000 of that $500 that they never see is my problem. Does that make sense? It's going to increase my loss. That's what's going to happen if they don't collect it all. Okay? So that's 5% of the $500,000. Now those numbers can be any numbers you want. That 3% and 5% can be whatever you negotiate. That makes sense? The worse your credit is, guess what? The worse your receivables are, your customer's credit is, the bigger those numbers are. Got it? Okay? If they're pretty good, the numbers are small. Okay? So anyway, and of course these guys then have a due to, they're going to pay them, if they collect the whole 500, they're going to pay the 25 to them. So that's a liability for them. Due from is a receivable, an asset. Got it? One's got a payable, one's got a receivable. Pretty straightforward. If you see it and you understand it, the terms are all new, right? The accounts are all new, but the ideas aren't. Okay? All right. Cool. Lovely. All right. So assume they are sold with a recourse with recourse. Okay. And Crest Textiles determines the recourse has an obligation of $6,000. What does that mean? I think that in addition to the $25,000 that they withheld, I'm going to have to pony up another $6,000. I'm going to have to pay them another $6,000. Make sense? So I think I've got another $6,000 of what? Oh, I said that wrong. The six is the portion of the 25 that I expected not to get. Okay? I think there's going to be 6 that they don't get. Out of a 500, I think of total receivable, I think there's 6 they're never going to see. So what's my loss? Not 15 fee they charge me. It's 15 plus the 6 I'm never going to see. Right? They're only going to collect $494, not 500. They're never going to send me down 6. You got the idea? So I think my loss is what? The 15 I already had for the fee, the 3% fee, plus another 6. They did a strange way to do it, but it's fine. But, right, 6 more. Got a recourse liability now. So if it's with recourse, you have to change your journal entry just a little. Now, by the way, am I going to tell the factor about that 6? If I'm factoring my receivables and I'm trying to get the best deal I can from them, I'm going to say, oh, by the way, I don't think you're going to collect the whole 500. No, I'm not going to tell them that. So does the factors change their journal entry? No. They record the $15,000 of factoring revenue, and that's all. What am I going to do? I'm going to show $21,000 loss. And here it is. Notice that Crest Textiles now has a $21,000 loss. The 15 plus 6 more. Notice, okay, and they have a recourse liability. See it? So I think the due from of 25, we don't reduce the due from We recorded recourse liability instead. I think that I'm never going to see 6 of it, right? Okay? And then commercial factors, guess what? Theirs stays exactly the same. They don't know about the 6, and I'm not going to tell them. Everybody good? So, we'll stop. I'll pick up there next time. Let me remember 85. We'll do a few examples next time, too. Okay? Good stuff? What I'll do is next time we'll do if we collect all of it, or if we collect part of it, or we collect even less, you know, that kind of thing. And what happens to the journal entries, kind of drives you crazy, though. Figure it out. See you guys. Works and problems, huh? If you have any questions, then you call us, obviously. And who's coming for the review? You are, 3 of us? The time bad, 2 to 4?
Yep.
Every time is bad for you people?
Pretty much.
I can't believe you did a class.
Well, it's too hard. If you want to have it right now.
We should just do it now?
We will be here 10 minutes.
Maybe you're for the
Dear.
next 15
For 15 minutes, then maybe.